Hey, how's it going? Shaun Carney here with Bolt Financial Group. Shooting this video just to kind of explain what it is that Bolt Financial Group does, how we help clients, and so we'll kind of walk you through the Bolt difference. And so the first step we do when we meet with the client is we look at their current portfolio. And so that includes your 401k, your IRAs, any brokerage account you may have, and we plot it against your risk versus return. So in this chart, we've got your risk down here is measured by standard deviation, just a statistical measure that really measures volatility in your portfolio versus how much you're getting in return. And ultimately, we'll plot your current portfolio against the portfolios that we have. And what we're ultimately trying to do is it possible to reduce your risk and get the same return that you're currently getting? Or is it possible to keep the same risk you have right now and increase the returns? Because those are two things people are going to want to do. And so what we'll do is we'll plot your current portfolio on this chart. And we'll find out how much risk is in your portfolio compared to how much return you've been getting in your portfolio. And then we'll see if it's possible to reduce your risk and get the same return, or increase your return but keep the risk the same. Or maybe you're like, you know what, hey, let's shoot for it all. I want to increase my risk and get a higher return. We'll take a look at the portfolios that we have to see if it's possible. Again, we don't know what's in your current portfolio, but if it's possible to reduce the risk and get the same return, or to keep the same amount of risk and get a better return, who wouldn't want to do that? It'd be worth your time to kind of figure out whether or not that's possible. The other thing we'll do is we'll go through a risk tolerance questionnaire. And what we're really trying to do is find out how comfortable you are with the ups and downs of the market. And once we find that out, we'll plot your current portfolio against what you said your risk tolerance is. And therefore, you can find out, is your current portfolio aligned with what you say you're comfortable with in the market? That way, if 2008 were to happen, a really, really bad market, you'll be able to know how much your portfolio could lose in any given bad year. And you want to be comfortable with that number. And if you are, that's a good thing. If you're not, then you might want to make some changes in your portfolio. So we'll check those things out. We'll also do a deep dive analysis where we look at how much you have in stocks versus bonds and kind of how diversified you are between all the different types of stocks and bonds that are out there, small and value and growth versus large. So we'll plot all of that to see if it's possible to diversify your portfolio even more. What diversification is really making sure you don't have all your eggs in one basket or one asset class. And we'll look at, are you all in North America? Are you developed? Are you spread out across the globe? Again, further mitigating some of those risks that could be in your portfolio. The other thing we'll do is we'll look at how much you're paying in fees, okay? And not just the fees that you think you're paying, but really the fees that are buried in your portfolio. And so we'll look at those numbers and we'll show you what kind of fees are happening in your portfolio. Because ultimately, if it's possible to reduce the amount of fees you're paying, that's more money in your pocket. Who wouldn't want to reduce the fees that you're paying? And so we'll take a look at what's happening. Then we'll go over the overlap report. And what this report shows is how many mutual funds you currently own in your portfolio that are all really just buying the same exact stock. And so what this is it's more fees that you pay without getting any diversification. And after working for a large brokerage firm, I know why some of these things happen, okay? And it's unfortunate, but some advisors will take your money and they just spread it around between all the different mutual funds because they want those same mutual funds to give them kickbacks, right? Whether that's taking them out to dinner, taking them to a ball game, whatever it may be, they're trying to spread your money around between all the different funds. And so in this example, there's 4 different mutual funds that are all buying this one holding. And we would like to reduce that in your portfolio because, again, that's less fees that you pay. And, it adds no value for you to have multiple funds that you're buying that don't get you any diversification. So we'll take a deep dive and kind of look at all your current investments in your 401k, your brokerage accounts, and your IRAs to see, is it possible to reduce your fees? Is it possible to increase your return? Or is it possible to reduce your risk, right? Those are 3 things that everyone inherently should want to do. And why wouldn't you want someone to just kind of take a second look at it and see if it's possible to improve your portfolio? The next part that we'll go through is developing a financial plan. And this is really where we work collaboratively with you to find out whether or not you're doing the right things today to achieve your long-term goals, or finding out whether or not your retirement savings are going to last. And so we'll kind of give you some action steps. We'll find out what your net worth is, and we'll give you some target goals to kind of set for your net worth moving forward. We'll find out what your assets are versus your liabilities. We'll look at where your money in retirement will be coming in from, whether that's Social Security, whether that's your employment, whether that's your investment accounts. And then we'll look at where your money is going ultimately. Because what you'd like to do is find out, are my retirement savings going to last? And so we'll plot that on a chart. And this chart will show you, if you keep doing what you're doing, will your retirement savings last? Hopefully the answer is yes. If not, we'll give you some recommendations to improve that. Also, it's really a good way for you to test the different things that you want to achieve. And so again, this isn't a sale. There's no product or anything like that. A lot of advisors will say, oh, you're going to come up short. You need to buy this annuity or this life insurance product. Well, that's not what we do here. We don't even sell annuities or life insurance. We don't ever want to have a conflict of interest. So we use this as a tool for you to test the different things that you want to test. And by that, I mean, you'll be able to tell us what happens if I retire at 58 versus 63. What happens if I take Social Security at 62 instead of 70? What are the long-term implications of me making the decisions that I make? That way, you can make an informed decision about when you want to retire and how you want to retire. You can test things like how much money you spend per month in retirement. You can test things like what happens if I buy a house in Florida or wherever it may be. Are those decisions going to have a long-term impact on whether or not my retirement savings are going to last? Okay, and that's ultimately what people want. They don't want someone to sell them a product. They want them to test their ideas. And that's what we do for you. We also give you kind of a probability of success. How likely is it, based upon the decisions that you want to make, that your retirement savings will last? And so that's really the meat and potatoes of our first appointment when we link up, is we analyze your portfolio, see if it's possible to reduce fees, see if it's possible to reduce your risk, or see if we can possibly increase your return. If none of those things are available and you're doing the best job possible, we'll be able to find that out and you can continue on your merry way. If it's possible to make improvements, why wouldn't you want to make an improvement? And so we'll give you the option to kind of take a look at that. And then the financial plan is really where you get to kind of test the different things you want to test and see if it's possible to kind of narrow down how much money it is that you need before retirement, and will that money last based upon the things that you want to see. Again, a great kind of analysis of the current snapshot of where you're at and kind of testing where you want to be in the future. All right. The next part of what we go through is kind of our investment philosophy. And the ultimate goal here is to find out, does it make sense for us to work together? Because if you're someone that doesn't agree with our investment philosophy, like, it's just not going to work out, right? We're not going to be a good fit for each other. And I'd rather figure that out now than, years down the road or a couple months down the road. And so our investment philosophy is founded in academics. It's not some random thought that I have. I don't try and time the market. I don't try and buy individual stocks, because ultimately what the research shows is no one knows, right? I mean, mind blown here, but no one can predict the future. And so we certainly don't try to here. What we do is we believe the academics that have kind of looked back at all the research and statistically proven the best way to increase your return. And what it ultimately does for you is it gives you peace of mind, because you don't need to try and time the market. You don't need to try and pick individual stocks. Instead, you can know that your money is in a portfolio that aligns with your risk tolerance. And if you just make consistent investments and stay disciplined, you'll get the long-term return. And here's how we do that. Okay, we use what we call the free market portfolio theory. And the free market portfolio theory, like I said, is based on 50 years of academic research. It's a disciplined approach that seeks to get market returns based upon your comfort with the ups and downs of the market. It has three components in it. First is that the free markets work. The second is that the modern portfolio theory is effective and is a best way to kind of maximize your return given your risk tolerance. And the third is the three-factor model. And this is how we're able to actually reduce your risk and get you the same return that you're getting, or actually get you a better return given the same risk tolerance. So these are kind of the meat and potatoes behind the free market portfolio theory and how we invest. So it is an academic philosophy based upon Nobel laureates. Okay, this is the research they came up with. And the reason we do this is because it is a conglomeration of the modern portfolio theory and the three-factor model, which were blessed by PhDs across the globe. Okay, so the top minds in economics and finance said that this is statistically proven to be the best way to invest. So why would we try and recreate the wheel, right? We do what academics say. The reason not everyone invests this way is because it's not sexy, right? It's boring, right? It's what academics say. When you look at kind of some of the big firms out there, they're trying to sell you a sexy product. And so they have to differentiate themselves from everyone else. And so to do that, they try and guess, and they try and create these mysteries out there that they can actually beat the market returns. When these guys, these PhDs, were able to show statistically that the probability of you being able to outperform the market by timing and picking individual stocks is actually all luck. In fact, only 20% of people are able to do it over a long term, which is why it doesn't make sense, okay? And so in order to believe this, you have to believe that free markets work. In a free market, at any point in time, the actual price of a security will be a good estimate of its intrinsic value. And this makes sense, right? What it's saying is that the price of the stock in the stock market is the best price that we all know. Any information that's available is priced into there, right? 8 million trades happen a day on over $800 billion, right? That's what happens on average in the market on a daily basis. If there was some inefficiency out there where people that knew a better price of a stock, it would already be priced in there. So if someone at the golf club or someone in the cubicle next to you is saying that they believe that some market or some stock is going to go up or down, right? It's already priced in there. The investments have already changed hands, and there's no reason to try and believe that. And that's good for you because it gives you peace of mind. You don't have to stay plugged in to all these different media outlets. You can just put your money in a portfolio that you're comfortable with and stay disciplined and get the long-term return of it. And so if you believe that, you try and capture market returns. You eliminate traditional investment strategies. You don't have to listen to the media and the news and what your buddy at the golf club or in the cubicle next to you is telling you. You can structure your portfolio based upon the different asset classes that align with your risk tolerance. You can diversify that portfolio across the globe, across as many companies as possible to try and eliminate some of the risks that are inherently out there by picking individual stocks. And then ultimately work with a financial coach that believes in the same strategy as you. If you don't believe that the free markets work, then what you have to do is focus on active management. That means you have to pursue traditional investment philosophies where you believe that there's financial advisors out there that can consistently predict the future, which just doesn't make sense, right? But that's what you have to believe. And so in order to do that, you have to stay connected to multiple sources of financial information because you're looking for that one nugget of information out there that hasn't been priced into the 8 million trades that happened that day. You're looking for that one piece, right? And if that's the case, then you work with a financial professional who shares that belief and will try and call you and sell you, a different product or a different investment because they found out some nugget of information that no one else knows. All right. The second component of the free market portfolio theory is based upon the research by Harry Markowitz, William Sharp, and Merton Miller, and that's the modern portfolio theory. All right. So Harry Markowitz was a professor at the University of Chicago, which is arguably the best economics and finance program in the nation. And his research essentially showed it's possible to reduce your risk and get market returns by diversifying your portfolio appropriately amongst all the different asset classes. And so in there, we measure your current risk. And we showed you this chart earlier. We want to look at how much risk is in your portfolio and how much return is in your portfolio. And so we're going to plot it in this chart. And so what he essentially found was that the relationship between risk and return is not linear. It's not one unit of risk for one unit of return. But you can actually bend that curve if you have the right blend of asset classes in there, right? And so that's what we try and do. We diversify your portfolio. And the best way to do that is to buy as many different stocks as possible because you want them to be uncorrelated. You want one to go down when the other goes up so you can kind of smooth out some of that volatility. And in the research, you kind of see that the S&P 500 historically has gotten about a 17% standard deviation and a 10% return, right? And it's possible to get that same volatility, that same amount of risk, but increase your return by having the right blend. And so we'll plot your portfolio on here and see if it's possible. See if you can get in line with the academics, the Nobel Prize winning research. And what they found is that the determinants of the portfolio is not actually market timing. It's not other factors. It's not stock selection. It's actually how much diversification is in your portfolio. Are you in the right asset classes to increase your return? We'll take a look at that. And kind of a simplified version to kind of show proof of this, from 1970 to 2016, we looked at the S&P 500. And what we see is that if you're just in the S&P 500, you get about a 10% return with about a 16.5% standard deviation. Right? What that and so another way to look at that is if you add in just international, you get about a 10.25% return, but you actually reduce your risk. So what we see is that the more funds and the more asset classes we add in there, the more we can actually get the same return but lower our risk. It's even further defined if you go, if you add in international and international small, you can actually increase your return and lower your risk. And this is what we do for people's portfolio. We apply the academics to their portfolio to see if it's possible to get a higher return given the same amount of risk or reduce the risk. The other part of that is a three-factor model. And in this research, Gene Fama and Kenneth French found that there's three premiums in the market. And what we try and do is build portfolios that capture these three premiums. The first premium is that equities or stocks are riskier than bonds, but they get a higher rate of return. And we see that in the research. So the S&P got about a 10% return from 1926 all the way to 2016, but it had more risk. And then bonds had a lower return, but a lower risk, which makes sense, right? Stocks are riskier than bonds, but you get rewarded for that because you get more return. And so finding the appropriate blend of stocks versus bonds in your portfolio can help you stay invested for a longer term. The other premium that he found was that small companies are riskier than large companies, but they have a higher return. And again, 1926 to 2016, the data reflected the same thing. Small companies tend to outperform large companies, but you take on more risk for that. The third factor was the value factor. And what this says is that companies that are value companies actually get a higher return than companies that are just stocks, but they take on more risk. Again, this makes sense. You're getting more return given more risk. So there are three premiums out there in the market: stocks versus bonds, small versus large, and value versus growth. Our job is finding the appropriate blend to increase your return but lower your risk. Because if we blend them all together in the right manner, we can actually increase your return. So that academic approach summarized is that free markets work, plus the modern portfolio theory, plus the three-factor model give you the free market portfolio theory. And that's how we invest people's money. So again, not a product, not a sale, just the proper blend of the right asset classes across the globe to make sure that we're capturing the premiums that are out there in the market. So we put you in a portfolio that aligns with your risk tolerance. It's very boring. It's very simplified, but academically proven to get market returns, which is ultimately what we want. All right, so how do we build these portfolios for you? So Dalbar Research comes out with a study every year, and it shows that the average investor gets about a 3 to 4% return, okay? Where the market actually gets about a 10% return over a 10, 20-year period. And so that's what they found in this study from 1987 to 2016. They actually publish it every year now. But it's quite powerful, right? And the reason that most people get a lower return than the market is because they take on the traditional investment philosophies. And what they do is they only hold on to things for about 3.5 years, because then they start hearing information, right? They hear that information from the person at their work or their uncle at the Christmas party that says, I'm buying this stock, or I think I'm going to pull out of the market now. And so, I think maybe that's what I should do too. So we actually hold on to things much shorter than we actually should compared to the academics, right? The other thing is we chase our returns, and we see this all the time in 401ks. Most people make their investments in their 401ks based upon whatever fund did well in the past. And so they just chase that market return. The other thing we see is active stock picking. And that's people saying, I'm gonna buy more of X company because I think it's gonna do well, or there's an earnings report coming out, or things like that. Well, what the research shows is that actually hurts our portfolio. By doing that, we're trying to time the market, and timing the market actually destroys our portfolio. And that leads us to our fourth one, market timing. And I hear this all the time. People come in, they ask me, hey, what do you think the market's doing? How do you think it's going? And I always tell them the same thing. Over the long term, the market's always positive. It's always green, right? Historically, it has been. But if I try and predict that in the future, I can't do that. In the short term, I have no idea what the market's going to do. I have no idea what the political situation is going to be. I have no idea if there's going to be some major event in the future But I do know if I buy and hold securities for a long time, I can get the market returns that have been proven in the academics. All right, so how do we do that? Is we build a diversified portfolio. So this example portfolio, again, 1970 to 2016, if I just bought the S&P, I'm going to get about a 10% return. Again, I see that 17% standard deviation. If I start adding in some intermediate bonds and some short bonds, I can actually, I'll lower my return a little bit, but I drastically lower my risk. If I further dilute my portfolio and add in more investments, I start adding international and international small. I don't get the same return, but I increase a little bit, but I actually keep my risk much lower. Again, this is just a simplified value, but now I start adding in small stocks and value stocks. Now all of a sudden I'm getting a higher return, but lowering my risk. And this is what we do for people. This is how we create portfolios. And this is how we can get market returns with a lower risk, by following the academics. All right. We also follow an investment formula here at Bolt, so that's completely transparent and everyone knows what we're doing. And the reason we do that is for asset allocation to help determine your risk tolerance. We want to put you in a portfolio that you're comfortable with the ups and downs, so that you stay disciplined and you don't hold on to it for 3.5 years and get the 3% return that people are getting in the market. We want you to hold on to it for 10 years or longer and get the market returns like the academics. We also do this to help monitor your investments and to prevent you from believing the Wall Street bullies out there. We don't want you to believe in some investment product that ends up making the investment advisor tons of commission and doesn't help you at all. We want you to be in a portfolio that's simple to understand and you can stay true to. We also do this to keep you from buying high and selling low. We all know inherently that we shouldn't do this, but our emotions are so powerful, and there's so much research going on right now in the emotional decisions that impact our investments. And so if we stick to a formula, we can make it objective and get rid of all those emotions. So our formula is we buy equities or stocks that align with your risk tolerance. We talked about that over and over, but we want to put you in a portfolio that you're comfortable with. We don't want to invest in it, put you in a portfolio that's outside of that, because that creates anxiety. We don't want you to have anxiety. We don't want you to question why you're there. We want you to go to bed at night sleeping comfortable, having peace of mind, knowing that your portfolio's your money's in a portfolio that aligns with how comfortable you are with the ups and downs of the market. Step 2 is we diversify prudently. That means we buy as many stocks as possible. So we'll try and buy 17,000 different stocks across 45 countries, because the probability that 17,000 stocks across 45 countries all collapse and go to zero, if that happens, we've got much bigger problems to worry about than your retirement portfolio. Okay, so we're going to diversify across the globe. So again, so you have peace of mind. The last thing we do is we rebalance your portfolio when it's misaligned. So we look at this quarterly. What we'll do is we'll look at your portfolio, and if it's misaligned by more than 5%, we'll make an adjustment back. And the reason we do this is because it's very objective, it's very transparent, and you don't ever have to wonder why someone's buying and selling your portfolio. You can go to sleep at night knowing that everything is done based upon an objective format, not an emotional decision. So for an example here, your portfolio might be 75% stocks and 25% bonds. The stock market might do really well, and all of a sudden now you're in a portfolio that's 80% stocks and 20% bonds. Well, you unintentionally took on more risk, and now you're in a portfolio that may not be aligned with your risk tolerance. So what we'll do is we'll rebalance that back to a 75-25. And what this systematically does is it buys low and sells high, right? We know we should do that, but if we don't have a formula in place, do we really know if we will? So that's Bolt's investment philosophy. And so if you're looking to kind of have an analysis done of your current portfolio, find out where your risk tolerance is, find out whether or not you can maximize your return or get the same return and lower your risk, find out if it's possible to reduce the fees in your portfolio, develop a financial plan that kind of gives you transparency and gives you an informed decision on your retirement savings without anyone selling you a product, without anyone trying to push you into doing something you're uncomfortable with. And if our investment philosophy aligns with yours, I would love to sit down with you and kind of figure out if it might make sense for us to partner together so that I can help you achieve your long-term goals. If you have any question about how Bolt invests or how we help individuals, please continue to reach out to us. I look forward to talking to you in the future.